We kick off another important week on the calendar with the Federal Reserve and the Bank of England taking centre stage in the next few days. So in today's video, let's take a look at what we can expect from these two central banks. Hello and welcome back to our channel. My name is Daniela. In today's video, as I said, we are going to be doing a bit of a preview of the Federal Reserve and the Bank of England, looking at how the recent data has come in from the prior meetings and what we could expect at this meeting, but also in terms of forward guidance and how markets could react to that. But before we get into it, please like this video, comment, subscribe, and turn on your notifications. And as always, if you have any questions about the markets or trading in general, feel free to leave it in the comments down below. And do know that this is not to be construed as investment advice or research. Now, as I was saying, the Federal Reserve will be taking centre stage on Wednesday and then followed closely by the Bank of England on Thursday. Now, since the previous meetings in mid-December, we have seen some updated data come out. And overall, the feeling is that the US economy is very strong, is remaining resilient, while the UK economy is showing clear signs of struggle. So let's start off with the Federal Reserve first, as they will be meeting on Wednesday. Now, as I said, the latest data for growth show that GDP grew 3.3% in the last quarter of 2023. That is a preliminary reading, and that can be adjusted higher or lower. But overall, 3.3% growth coming from 4.9% growth in the third quarter. So that is a remarkable pattern of growth in the US economy, even at current rates standing between 5.25 and 5.5%. So even as monetary policy has remained restrictive for the past few months, we've seen growth in the US economy really take fold and really shows the resilience in US consumers. The labor market remains tight. So realistically, when looking at what to expect at this meeting, markets are pricing in pretty much a sure chance of no rate cuts at this meeting. But we did see Powell in December start to talk potentially about rate cuts further down the line. He did have a little bit of a dovish tilt that markets weren't expecting at the time, especially given how the US economy is so resilient compared to others like the Eurozone economy or the UK economy. So that dovish tilt from Powell did send some repricing in the markets. We saw equities, US equities, and the US dollar react on the back of that. We have corrected course since then, as some FOMC members have come out to push back on those market pricing, given Powell's commentary in December. We have had some comments, for example, from Loretta Mester, saying that the central bank is more aware of cutting rates too soon than holding them for too long. I think what they don't want to do is start cutting rates and then have to reverse course. So I think the Federal Reserve is going to be quite conservative with this, and I don't think any rate cuts are coming anytime soon. Markets are pricing in a 50% chance that they may cut 25 basis points in March. I think that is too soon. I think we may have to wait until the second half of the year to actually see any move on rates, mostly because the data just isn't demanding it yet, even though, yes, it enables the Federal Reserve to cut rates because we've seen inflation dropping. We actually see the PCE data on Friday, which is the preferred measure of inflation from the Federal Reserve, actually coming in below expectations. Core PCE remaining below 3%, which is the lowest since March 2021. So yes, there is reason to cut, but there is no real need, no necessity, no urgency to do so anytime soon. And as I said, the Federal Reserve is in a much better position than other central banks out there, and they have yet failed to start cutting rates, not even just cutting, but failed to mention cutting rates. At the ECB meeting last Thursday, we saw Lagarde pushing back on any future guidance, really giving no indication as to when the central bank sees those cuts starting. At the Federal Reserve meeting this week, as I said, no cuts expecting, but there is going to be a lot of focus on forward guidance. Powell was generous enough to give some sort of indication at the December meeting, so markets will want more insight from that. They'll want to know when the Federal Reserve is planning to see the next few cuts. Has that changed from the December meeting? Remember, we saw the updated projections in December. We won't get them now, but back then they were suggesting 3 rate cuts in 2024. That is much less than what markets are predicting, currently pricing in around 150 basis points of cuts. So there's a lot of disparity between what markets are expecting, what the Federal Reserve said they were expecting in December. So markets will want to know, has Powell changed course? Has any of the upcoming data had any influence on the central bank? And that is likely going to move markets this week. If we do see Powell continue with its dovish remarks, taking markets potentially a little bit more by surprise, especially after the pushback that we saw from central bankers throughout the month of January, and especially in Davos when we had the World Economic Forum, we saw a lot of hawkish commentary. So if Powell pushes back on that and kind of keeps to his dovish commentary and again talks up rate cuts, then we could see the US dollar retrace the positive momentum that we've seen in January, and US equities continue the push higher. Conversely, if we see a return to hawkish commentary pushing back on the need for rate cuts anytime soon, we'll have the opposite effect. We'll likely see the US dollar building some momentum and equities actually coming down from the all-time highs that we've seen. Bank of England, slightly different picture here. Again, markets expecting no rate cut from the Bank of England at this meeting. The situation is quite different. As I said, the UK economy is struggling more than the US. In fact, it's still not clear if the UK economy will have avoided a technical recession in the last half of the year. Just managed to scrape by in November, so that has pushed away concerns for technical recession. But nonetheless, we are seeing subpar growth in the UK economy. Retail sales are dropping, manufacturing production is dropping, sentiment around the UK economy is dropping. So there is more concerns for the future of the UK economy. But inflation is also higher. We saw an uptick in December in CPI. And of course, we know the Bank of England has been notoriously slow in adapting their monetary policy in the past. So I just don't see it yet, the ideal conditions for the Bank of England to start cutting. Markets pricing in 95% chance that there will be no cut. So again, not much expected at this meeting, but again, it's going to be all about the forward guidance. As I said, the UK economy in a more dire situation than the US. So the Governor Bailey may feel more need to explain the future of monetary policy. He may, of course, follow Lagarde's steps and fail to give any future guidance. We will have Bailey speaking after the meeting on Thursday. So again, markets will just want to know what is his thought process? What is the MPC expecting over the coming months? Is the situation prepped for the cutting cycle to begin? And just overall with this week, the Federal Reserve and the Bank of England are in very different situations. They're in different periods of the economic cycle. But the Federal Reserve seems to be more inclined to giving markets more information and more of a guideline on when their cutting cycle would begin, whereas the Bank of England seems more reserved, like the ECB, likely because they are conservative with making forward guidance. They're not very confident as to what their projections are just yet. So they seem to be avoiding giving any future indication. That may not be the case this week with the Bank of England, but of course that is where most of the focus from markets is going to be. Let's jump on the charts now quickly to take a look at how the markets have been trading. We can kick it off with the US dollar index because the US dollar has been remarkably strong since the beginning of the new year. We've seen some repricing in markets. I said some commentary from central bankers, especially during that week in Davos, kind of pushing back on Powell's excessive dovishness in December. And that, of course, allowed the US dollar to recover some momentum. Technically, the index was quite oversold as well. So that allowed for the recovery to take place. But we saw some sideways consolidation, then once again managing to push higher. But again, we've got to that period of consolidation. Buyers are not yet convinced with the follow through. New buyers are struggling to come in. And there is some fair amount of resistance up ahead. Of course, this Wednesday's meeting could be a catalyst for the US dollar. As I said, if we continue to see hawkish remarks from the Federal Reserve and Powell actually taking the stand this time and saying that, yes, it's too soon to start considering cutting rates, then the follow through in the US dollar could continue potentially pushing above the highs that we saw back here in December, just prior to that FOMC meeting, potentially pushing all the way up to 104. Now, if we do see a follow through of the commentary that we saw in December and therefore a dovish Federal Reserve, then the reversal lower in the US dollar could actually take shape after some clear resistance from sellers and new buyers struggling to come into the market. Taking a look at the pound against the US dollar, As I said, the resistance that we've seen in the US dollar has actually allowed the pair to continue to build those higher lows. Again, struggling to find any clear direction. I think the candlesticks here on the daily chart showing that, seeing some sideways consolidation. There is appetite to continue pushing higher, but there is a clear area of resistance up ahead. This area between 128 and 128.30 has been clear resistance since August last year. When we were back at the highs at the end of December, we saw some resistance there. And so a lot of the momentum this week is going to come from these two meetings. Of course, the Federal Reserve meeting will be a key catalyst. And with this being a US dollar pair as well, it's likely that a lot of the momentum will come from that. Again, a stronger dollar will likely weigh on cable, potentially pushing back to this 50% Fibonacci level here at 125.90, where we've seen some support in the past. So Thursday's BOE meeting could deliver a little bit of momentum for the pound, but in terms of cable, it's likely going to be subdued or limited to what the prior day momentum has been. But a Bank of England that keeps on pushing back on rate cuts would allow the pound potentially to gain a little bit more of an upper hand, especially if the Federal Reserve has been slightly dovish the day prior, mostly on the back of rate differentials. But technically, the pair is clearly looking for direction. The RSI just hovering here around the midline, struggling to really determine where to go next. So there is enough, I think, momentum to push higher or lower at this point. It's just going to be a case of how the next few days play out. That is it for today's analysis on the central bank meetings this week. Thank you so much for watching, and don't forget to subscribe to our channel.